These days, there sure seems to be a lot of discussion about interest rates and how they're going to affect pension and specifically lump sum options. So if you're facing retirement or a separation of service, you may have some questions around this important fact. Hi, Jim Krzan here. And for nearly 40 years, my team and I have been working with folks just like you to help design, engineer, and build bigger, bolder retirements. So what do we know for sure? One thing is every single pension plan is different. They calculate the retirement benefit differently. They use different dates to assess lump sum valuations. But one thing for certain, that lump sum valuation is based on not only prevailing interest rates, but more importantly, the change in interest rates year over year. And at this time of the year, as pension plans are reassessing their valuations, we're realizing that interest rates have gone up a ton since the last valuation. And as a result, the lump sum value is going down. In many cases, the amount that it's going down is anywhere from 15 to 20%. And this is causing a lot of anxiety amongst folks who are getting close to retirement. It's causing people to reassess whether they should take a lump sum when maybe they never thought about taking it in the first place. It's also causing others to consider maybe pushing forward the retirement plans when they really had no thought of doing so. So let's talk a little bit about what components we need to look at to determine whether a lump sum makes sense. Essentially, at the end of the day, there are a number of factors that get built in. Today, we're going to address three of these. The first being financial. And with that, there are a couple of subcomponents. First and foremost, we need to figure out what's called an internal rate of return. We call it a hurdle rate. Think of it as, what is the rate of return that this lump sum needs to earn for the rest of my life so it's equivalent to the pension I'd be getting otherwise? That's an important number. If it's too big and the number is not achievable, it makes better sense to take the pension. If the number is quite low and quite reasonable, considering market valuations, considering assets you already have, then taking the lump sum might very well make some sense. In addition, we need to look at exactly when we add this to everything else you have. What is the distribution rate? What is the percentage of everything you've accumulated, including this lump sum? What is that percentage of what needs to be distributed out of the account every year to drive your bigger, bolder retirement? If this lump sum is the biggest bucket you've accumulated, the decision might not make the most sense. If you've already done a great job of accumulating money and this lump sum is essentially the cherry on top of the sundae, then there's a lot of really strong benefits in taking a lump sum. Additionally, beyond the financials, we need to look at other resources. Is there another guaranteed source of income coming in the household? Maybe a pension from a spouse. What does Social Security look like? And more importantly, what kind of gap in time do we have between drawing income now and receiving some of those other benefits? And then the last aspect is tax location. And specifically, is everything that you own completely taxable as you pull it out? Or are there other buckets that might be tax-free, or what we would prefer to call tax-preferred? And what impact does that have, not only now, but down the road? Remember, at 72, you have to take a certain amount of money out of your retirement buckets. And does that then cause a much bigger taxable income than otherwise? We need to look at things now, but also note what it will look like in the future. And then the last component is time frame. If you're planning on retiring now, and it just happens to be the time that the lump sum is getting recalibrated, and it makes sense to take the lump sum, then certainly it makes sense to do so and do so now. But what if you weren't planning on retiring immediately? What about retiring in the near term or even further out? Well, the answer then is a little bit murky. It has a lot to do with what resources you'll have in the future. As an example, salary, company match. Do you have a vehicle? Is the company paying the lion's share of your health care, which you would be responsible in retirement? What about your percentage of team bonus and so on and so forth? I'm willing to bet that if you rank those and added those up, at the end of the day, over the course of a year, you're receiving far more benefit by working with the employer than you would by simply taking that lump sum. Add to that the fact that you're starting your retirement a year or two further down the road, as opposed to tasking the portfolio to start creating income now, and it could be a game changer. So don't assume that just because the asset values are dropping, it will in some way hurt your retirement prospects. In many cases, your probability of success may actually increase by simply delaying your retirement. So, if you're considering retirement or are faced with a separation of service, undoubtedly, you have an awful lot of questions. Your success in retirement is really much more like a chaos theory, like the butterfly effect. Effectively, how you handle these random one-off issues that come up will really dictate what kind of bigger, bolder retirement you have. And this issue concerning lump sum or pension is one of the more important ones. And we'd love to help. Over the last nearly 4 decades, we'd worked with clients, looked at their data, looked at their resources, ran analytics, and provided advice that would help take their resources and create bigger, bolder retirements. And as I said before, we'd love to do the same with you. So if you're interested in continuing this conversation or having us run a hurdle rate analysis that'll give you a much better idea of where you are in terms of your own unique situation, just click the QR code at the end of this presentation, and we'd love to continue this conversation.